Like digging into the inbox here, Brian. These are legitimate questions. Johnny emails us and says, we currently have our primary home and a beach house. Our primary home is worth $500,000. Beach house is worth roughly $1 million. And we owe about $150,000 on each of them. I'll be getting an inheritance soon that will be enough to pay off one house or the other. But should I do that? If so, which one? For what it's worth, we're likely to sell the primary home in a few years and move to the beach.
I mean, it's hard to know without enough information to say should you pay the pay them off. If you're gonna basically sell one soon, there's not that big of savings, right? To pay it off that quick. But real estate. I mean, if they got $1 million. Beach house, depending on how long they owned it, what they're doing, if they have $150,000 of debt on each of them, I would prefer to have the one that they're getting rental income because they can deduct the interest dollar for dollar.
Oh yeah.
So, assuming the interest rate is the same, right? If the interest rate's 5% higher, then obviously
that makes a difference, yeah.
Right? But on your primary home, if you're not itemizing, then it doesn't make any sense to, have a mortgage if you got the money and you want to pay it off, right? Pay the one that you're not getting a tax deduction for.
Yeah, right.
Most people are not deducting interest, right? Because, they don't have enough to go over the standard deduction. So it's interesting. They want to sell the primary home and move to the beach. If they want to do the other way around, because the primary home, they get an exemption, right? It's $250,000 per person, up to $500,000 if they're married, filing jointly, to be able. So if they sold it for $500,000, obviously they paid something. So they can sell the house tax free and move the money to pay off the debt, right? Invest it in the market or buy other real estate. Which, if they've done well in real estate, a lot of real estate investors want to go back into real estate, right? So there's options. 1031 exchange, you know what that is, right?
I mean, I got an idea what it is. Can I tell you and you tell me if I'm wrong?
Yeah.
You take the money that you make from one establishment, you invest it in another establishment where you don't have to be the landlord, but you're still invested in another property.
Stop.
Wrong? Dang it. What was that one called?
Okay. Do not call Brett for financial advice. I'm just saying. He is not part of Integrity Financial Planning.
Delaware Statutory Trust.
Stop.
Okay.
It's all right. So it's a 1031 exchange. So a 1031 is a like-kind exchange. It basically allows an investor or a business owner to sell an investment property, right? And then it replaces it with another property. So it could be passive or active ownership. They don't have to manage it.
I think that's exactly what I said.
Yeah, that's exactly, pretty much. But it has to be of equal or greater value within a time frame of 180 days from the date of close, which is about 6 months, right? A little less than 6 months, actually. But using a qualified intermediary, which is a QI. We call them a QI, right? They hold the money until you roll it to the next property.
Oh, okay. Right.
And you don't get any interest, by the way. I don't know why. They never pay any interest, I don't think. If they do, it's not much. At least it didn't in the last couple of years. So the nice thing about it is in an example here, we've got an example, $1 million property, sales proceeds. The cost is $100,000. So there's a $900,000 capital gain, right? If they pay tax at federal, state, net investment tax, their net reinvestment is $731,000. Okay. That kind of stinks.
Yeah, that's a big hit.
So that's the problem when you're looking at assets. Drives me crazy because attorneys don't get this a lot. Where you're talking about assets and like, oh, that's $1 million. No, it's not $1 million.
No, it's 3/4 of that.
Yeah, let's cut off 30%.
Yeah,
because they really don't have that much. Now so they're they have to reinvest with only 731. If they get a 5% dividend payout on the new real estate they bought, right? They bought some projects or whatever, they developed it. Who knows? Whatever they did. You're taking 5% on $700,000, only $36,000.
Yeah.
That's not very good. On $1
Can't
million,
live on it.
you're generating $50,000.
Yeah.
And it's compounding interest over time. It's the saving taxes is not about the tax savings. I've said this 1,000 times, and people are getting it because they're coming in, they're listening to the show, they come in and they go, it's opportunity cost. I'm like, you're listening. It's about the money that's not there, and that money is able to be reinvested and not given to the government. And in 20 years, you've quadrupled your money because you didn't pay the tax, right? So here's the thing: you got $1 million with a 1031 exchange. You you sold the property. The original cost was still the same, right? $100,000. You had a $900,000 capital gain, but it's deferred. You didn't pay any federal at 20%. You didn't pay any state at 5.75 or 6, wherever state you're listening in, because that's about the state tax. Unless you're in California, it's like, what is it, 50%?
It's something huge. It's ridiculous.
In New York City, they got the New York City tax, the county tax.
Either of those two extremes are bad.
I mean, the federal tax.
One goes to the other is bad.
It's awful.
Yeah.
Anyways, so you actually have $1 million to reinvest. With real estate, the nice thing is once you buy another property, you could leverage that one a little bit with loans or in a passive Delaware statutory trust. That's what you were trying to say earlier when you were mumbling around.
Pretty good. It was pretty articulate, wasn't it?
Yeah, you were nailing it. So
were you like, I should probably bring Brett on as a financial advisor?
We have to train you a little bit first. But so the idea is the benefits are what? Passive investing. Some of our clients are getting to the point where, Brian, I don't want to do this anymore.
Yep.
I worked really hard. I mean, everybody has a checkout.
I don't want to manage crap at this point.
Yeah, you have a checkout part in your life. You're not there yet, and I'm not there. We're growing. We're younger, so we're trying to build. But somebody that builds to the point, and they go, I'm done. And sometimes it's health reasons. They're just like, I mean, we've got clients that are going, Brian, I got to quit now. Or my wife is sick in a nursing home, or they have some weird disease that we can't even pronounce, and the doctors can't even find it, but I've got to sell all this property. And they're like, but I'm going to pay 30% in tax on $2 million, $5 million, whatever it is, and it's crazy. And their CPA goes, I don't know what you can do. And the tax attorney goes, or the estate planning attorney that got their will done, I don't know. There's not really much you can do. Just pay the tax. I mean, bite the bullet. Financial advisor goes, yeah, I don't know. I mean, you can do a 1031 exchange. I don't know much about those, but you can. But then you're going to be managing other real estate. No, you're not. There's passive. There's thousands of Delaware statutory trusts, thousands.
Where somebody else manages.
Yeah, and they're professionals. You're not really a professional because these guys are managing billions of dollars. You have 10 rentals, or you have a little apartment building. In a small town. No offense, but the reality is they manage billions of dollars of commercial real estate. This is all they do, and they're really good at it.
Yeah.
Right? They know the pros and cons on, this is not a good property, this is not a good demographic. They do so much research before they actually even start developing the property, right? And buying on a whim. But the advantage of doing a passive investment is that you relinquish the burden of maintaining the properties. You don't have the tenants, the toilets, and the trash anymore to deal with.
The 3 T's.
The 3 T's, right? And so you obviously got the tax deferral, but right now, under current tax law, if let's say they live 25 years and the kids inherited and that $1 million property in 25 years grew to 7%, what would that be? Over $4.5 million or something, right? Well, there's $3.5 million gain. Well, there's actually like almost $4.5 million gain inside of it's still there. It didn't go away.
Right.
Well, when the kids inherit it, mom and dad pass away, it passes on tax-free with a step up in basis. So they got a tax deduction. Managing real estate's a great tax deduction. They generated income too, because it's just like real estate. It will generate income to you. Now, some of them will generate more income depending on what you go into, right? It just depends on the property. We have clients who are like, I don't need any income. All right, let's go into more of a growth property, right? Something that's going to grow more, isn't going to kick out a lot of income. It'll kick out more income down the road. You're still working. We have a client, he's like making $700,000 a year. He's like, I don't need any income, Brian. I got too much. I know, you're getting killed on taxes, right?
Yeah.
So we found one that's not really kicking out a large dividend. It's more of a growth property, and it's has the potential to be a really good property for him. It's a value appreciation kind of thing, right? So and you can diversify it. It doesn't have to be in one. There's not just apartment buildings, right? There's industrial, self-storage, student housing.
Storage is a big business now too, right?
Yeah, it's huge. Yeah. So it's what do you?
Do you do a lot of them?
What do you?
Do
what do you
those?
want?
Do you have experience in doing the 1031s and DSTs?
So 1031s. I mean, my first one we did was goodness, would have been 16, 17 years ago.
Oh wow.
So I mean, 1031's been around forever.
Yeah.
It's just the Delaware Statutory Trust is, I don't know, it's like financial advisors don't want to mess with them because they used to be very cumbersome with the paperwork. Like they used to be this big packet and, 700 pages. It's not worth it. And a lot of people only want to put 50,000 and 100,000 is just a pain in the neck, right? And you got this whole separate account and it's not at Schwab and it's just hard to manage. Where now a lot of the big custodians will be able to consolidate it on a statement so you can see it at Charles Schwab. It's real estate. You own a part of an apartment building in Florida, right? In Tampa, Florida, or Miami or Houston or, wherever you want to be at. Student housing projects, self-storage, and, Amazon warehouse in Northern Virginia or wherever you want to be. And the reality is it's a wealth building way, but you don't have the time involved anymore. Now you can actually have a life and actually retire.
Sounds amazing.
Right.
Sounds great.
Now there's pros and cons. You
Right.
have to be an accredited investor. That's kind of why we have a $2 million minimum. We're talking about this for investable assets for clients to come in the door, because you have to be an accredited investor, which means you have to have $1 million of investable net worth outside your primary home or an income of over $250,000. So they are great, but they're not for everybody.
1031 exchanges, DSTs, got questions? Here's where you reach us. retirementplannow.com. retirementplannow.com.